No, he never played for the Jets, but he did stick handle some difficult policy challenges as deftly as Blake Wheeler handles a puck. James Coyne, who died in 2012, served as governor of the Banque of Canada from 1955 to 1961. Now, as governor, he stressed that price stability should be the primary goal of monetary policy. And that principle, price stability, is now the cornerstone of monetary policy frameworks around the world. In practice, it is achieved by maintaining inflation at a low, stable, and predictable level. Our mandate at the Banque of Canada is to promote the economic and financial welfare of Canada. And like Governor Coyne, we believe that inflation control is the main contribution monetary policy can make to achieving that goal. Now, the framework that we currently have consists of two things: an explicit inflation target and a flexible exchange rate. Now, this arrangement was established in agreement with the federal government in 1991. Since 2001, it has been renewed every 5 years. And with this framework, we have anchored inflation expectations, achieved low and stable inflation, and promoted sustained employment and economic growth. Now, three factors have contributed to this framework's credibility and success. First, we have a clear, simple, and well-understood inflation target whose focal point is 2%. Second, the framework has political legitimacy, is coherent with other public policies, and is implemented with effective tools. And third, we have a formal review process for continually improving the framework. This review process is widely admired by many of our peers and was cited as one of the factors that earned us the Central Bank of the Year award we received recently. Allow me to say a few words in French. Trois facteurs clés ont contribué à la crédibilité et au succès de notre cadre. Premièrement, nous avons un régime de ciblage d'inflation clair, simple et bien compris, avec pour point central la cible de 2%. Deuxièmement, notre cadre détient une légitimité politique et il est cohérent avec autres politiques publiques et il prévoit des outils efficaces. Troisièmement, nous appliquons un processus d'examen en bonne et due forme pour améliorer constamment ce cadre que beaucoup de nos pairs envient. My speech today is the first in a series that my colleagues and I will be delivering over the next 4 years as we embark on our review of our framework leading up to the 2021 renewal of the inflation target. I'll start with some background on our experience and that of many other central banks with inflation in the 1970s and 1980s, and on lessons we learned trying to control it. I'll thus discuss how and why the bank adopted an inflation target for its monetary policy, and I'll review the impact of the policy on inflation, why it works so well, and the unique and innovative process we follow to ensure that it remains effective. Finally, I'll conclude with a discussion of the important economic developments affecting economies worldwide, strengthening the framework to manage the potential risks that these developments pose to the Canadian economy is the key objective of our research over the next 4 years. Now, like a ship, a central bank needs an anchor for its monetary policy, a fixed point of reference to help tie down expectations people have about inflation. During the 1960s, that anchor in most countries was a pegged nominal exchange rate that linked the value of domestic currencies to the US dollar. This exchange rate arrangement, known as the Bretton Woods system, collapsed in the early 1970s, largely because of unsustainable inflationary pressure in the United States. Without an anchor for monetary policy, inflation and inflation expectations rose rapidly, exacerbated by large oil price shocks. In some years, inflation hit double-digit levels in Canada and in other advanced economies, Some of you that are my age remember those days when inflation and interest rates were well into the double digits and interest rates almost hit 20%. Now, in 1975, the bank adopted as its new anchor a money supply target. But by 1982, we were forced to abandon it, or rather, it abandoned us, as former Governor Schembri once quipped, after it became clear that financial innovations had weakened the bank's ability to control the money supply and overall spending with its policy interest rate. Unfortunately, by then, inflation and inflation expectations had risen, and the expectations had become so entrenched that inflation only declined when the Banque of Canada and other major central banks boldly increased interest rates in the early 1990s. It worked, but at a cost of a severe global recession at that time. After this disinflation, the bank renewed its search for a viable nominal anchor and considered various options. We tried to identify one that would be effective, straightforward to operationalize, easy to communicate, and that the public would trust. In the late 1980s, then Governor John Crow delivered several speeches in which he laid out an argument in favor of price stability itself as a long-run goal for monetary policy. At that time, inflation was running at roughly 5%. No one knew with certainty what rate of inflation represented price stability. And economic theory was not yet developed enough to confidently predict the outcome of such a policy if implemented. Still, the idea of using the policy rate to directly target the rate of inflation held promise. At the time, only one other country in the world had attempted such a policy approach, and that was New Zealand, which adopted inflation targeting in 1990. Canada became the second country the following year when the Banque of Canada and the Department of Finance announced an agreement on a monetary policy framework that set a path for reducing inflation. The agreement gave the bank operational independence to achieve the inflation target, while at the same time acknowledging that a range of public policies besides monetary policy can make a significant contribution to controlling inflation. Since 1995, our inflation control target has been 2%, the midpoint of a 1% to 3% range. Central banks in many other countries, 37 in total, have now adopted an inflation target, and most, especially in advanced economies, have chosen 2% as their target. Experience suggests that 2% is sufficiently low that it does not materially distort economic decision-making and behavior, but still leaves the central bank adequate room to lower its policy rate in response to a significant adverse shock. Because a 2% target balances these offsetting considerations, it is symmetric. In other words, we care equally about deviations above and below 2%. We aim to achieve the target by adjusting our policy rate, which directly influences interest rates for household and corporate borrowing. Doing so helps us align for demand for domestically produced goods and services with the economy's capacity to supply them. If aggregate demand is expected to exceed or fall short of the economy's potential output, we typically raise or lower the policy interest rate to close the gap to keep inflation on target. It's not often that a policy performs better than expected, but our inflation control target just did that. Over the past 27 years, we've reduced inflation measured by the CPI and maintained it at a level close to 2% target with no persistent episodes outside our control range. And you can see that in this chart here, that before the target was adopted in 1991, inflation was very high and variable during that period. Since 1991, you can see the target is the black line and the range is the shaded area. That for the most part, inflation in Canada has stayed within that control range over the period of time, and there's been no episodes where there's been persistent deviations away from that range. Now, because inflation has been so close to the 2% target, It has served as an anchoring and coordinating mechanism, allowing Canadians to make better economic decisions and achieve better outcomes. In addition, there's been much less volatility in interest rates and output growth. What have we learned from this experience? Well, there are some key lessons that we can take from it. First, the clarity and simplicity of the 2% target has facilitated its communication and broad acceptance. And this has helped enhance the target's credibility. Second, inflation expectations have been firmly anchored at the 2% target. And so the effectiveness of our policy has increased. So I can show you in the next slide. Here are different measures of inflation expectations by different forecasters. And you can see that they're about 2 to 3 years out. One is consensus economics is the red line, and the survey of private sector forecasters is the blue line. And you can see that early in the period, early in the 90s, inflation expectations were much less well anchored. But over time, they've become firmly anchored at our 2% target. Now, the third lesson is the more successful we are at hitting the target, the more credible the policy is, and the more confident that Canadians are that inflation will remain on target. So we have this self-reinforcing feedback loop that has been instrumental in our ability to keep inflation on target. So to sum up this process, why is inflation targeting worked so well in Canada? Well, there's 3 factors that we feel that are important that have contributed to its success. One is that there's a clear and simple target, the 2% target, that's very easy to understand, and that's served as a focal point for decision-making in Canada. Second, we have effective tools. We have the political legitimacy that comes from the agreement with the government, and we have coherence with other public policies. Fiscal policy and financial and regulatory policy have all been coherent and consistent, and the 3 things have worked together to enhance the credibility of the target. And thirdly, we have this improvement process, this review process, that has improved the framework over time. And so these 3 factors have contributed to the credibility of the target, and so inflation expectations have become very well anchored at 2%. And as the expectations become more anchored, monetary policy becomes more effective. And if monetary policy becomes more effective, then we can keep the inflation rate on target close to 2%. And if we do that, there is this feedback loop that comes back to credibility. That if the private sector sees us hitting the 2% target on a regular basis, that will enhance the credibility of the target. Now, our experience in the 80s was we now discuss inflation in decimal points now, rather than in percentage points we worried about in the 1980s when inflation was running in some years above 10%. So there's a lot more credibility about the target as a result of our success in achieving it. While inflation targeting itself was very innovative, even more so was the joint agreement and its renewal process. For each renewal, the bank conducts a deliberate, rigorous, and transparent research program to critically examine important issues related to the policy framework. Based on this analysis, we adjust and improve our framework. And we look at 2 types of issues when we examine our monetary policy framework. The first are fundamental issues, and the second are operational. And fundamental issues include, for example, whether the target for monetary policy should be changed, and to what extent should monetary policy consider financial stability concerns. Operational issues include how to measure underlying or core inflation. Now, given the policy's effectiveness, the renewals have gone smoothly, but I can assure you that they're not automatic. The issues we research are based on monetary policy experience primarily in Canada, but also in other jurisdictions, and on academic and policy-related discussions and research. We also consult widely, most notably with the Department of Finance, as well as other central banks and policy institutions and the private sector. The renewal process has evolved over time as our experience and understanding of inflation targeting has broadened and deepened. Although we haven't made many changes to the framework, we've gotten better at operationalizing it. Most notably, having a well-understood and credible inflation target has facilitated and indeed demanded more transparent communications, since the public can now more easily hold the bank accountable for monetary policy outcomes. Finally, let me give you a brief, quick overview of some of the questions we have addressed in previous reviews. In 2011, we asked whether the 2% inflation target should be lowered to something below 2%. In 2016, we asked whether it should be raised, because that was a topic that a number of economists had brought forward. Decisions to alter the inflation rate require that we balance two considerations. On one hand, higher inflation is economically costly. It distorts the price mechanism and is socially unjust because many people, especially those on lower fixed incomes, cannot adequately hedge their financial situation against higher inflation. On the other hand, if inflation were higher, and if it were credible, which is a big if, would give the central bank a higher neutral policy rate. The level of the neutral rate is important because in the advent of an adverse shock, we would prefer to have sufficient room to lower our policy rate to provide stimulus without the risk of dropping it to zero or below. In some jurisdictions, as you know, policy rates have been lowered to slightly negative levels, but these negative rates appear to be less effective in stimulating economic activity. For both our 2011 and 2016 reviews, our research found that the 2% target roughly balances these two considerations, especially since our target is clearly understood and is very credible. In both reviews, we also examined to what extent the conduct of monetary policy should take account of financial stability concerns. We concluded that monetary policy should only be used in exceptional circumstances because it is most effective at achieving the inflation target, while macroprudential policy has proven useful for mitigating financial vulnerabilities. For example, in the housing market in Canada, we've seen a number of measures being taken by CMHC and OSFI to address imbalances in housing and the mortgage finance market. In addition, we've found that the post-crisis reforms have made the financial system more resilient. We know that financial stability is necessary for achieving our inflation target on a sustainable basis. Therefore, central banks must be mindful of the impact interest rate changes might have on financial stability and consider, when necessary, adopting a more flexible horizon over which to return inflation to target. As I mentioned, our next renewal is in 2021. At this stage in the process, we're examining recent economic developments that could affect the resilience of the Canadian economy. We are also assessing possible measures to strengthen the monetary policy framework to respond to adverse shocks and increase macro resilience. Now, three important developments in advanced economies could pose a challenge to our framework. First, our high levels of household and public debt. And so in the next chart, so you can see that what I've plotted here is household debt as a percentage of GDP. The red line shows what's happened in Canada over the last 25 years or so, and the blue line shows what's happened in other jurisdictions in the G7, excluding Canada. And you can see that in Canada, household debt has increased fairly steadily over the last 10 to 15 years, and much of that is mortgage borrowing, especially more recently as a result of the low interest rates we've had. In other jurisdictions in the G7, we've also seen household debt rise, and it's leveled off since the financial crisis. Now, if we turn to public debt, it's the opposite situation. In Canada, the red line, public debt increased, government debt increased as a percentage of GDP during the Great Recession after the global financial crisis because there was a lot of fiscal stimulus to help our economy recover from the Great Recession. In other jurisdictions in the G7, that increase in debt was much larger. So what we see is that overall, if we look at both household and public debt, it's increased significantly since the global financial crisis. And so now there's less room for additional borrowing to stabilize the economy in the event that there was another adverse shock across the G7 countries. The second development is that over the past 25 years, we've seen a gradual decline in interest rates, including long-term bond yields, and most importantly, estimates of the neutral interest rates. Now, a lower neutral interest rate reduces the scope for central banks to adjust their policy rate. And you can see this development in the next chart. So these are, again, real long-term bond yields, 10-year bond yields, and the Canada is in red, and the rest of the G7 is in blue. And you can see that since 1990, they've declined monotonically to a very low level at the moment. So again, that means that interest rates on average are going to be lower, and that leaves less room for the central bank to reduce interest rates in the event there was an adverse shock. And the third trend that we've observed is that economic growth, the underlying rate of economic growth, has been decreasing due to fundamental forces. First force that's important is lower labor force growth. In Canada, our population is aging, and this is true of other advanced economies, and this has caused trend or underlying potential output growth to decline. And second, many of these advanced economies have experienced declining labor force growth, which is more difficult to explain. I mean, there's a much debate about that, but in recent years, there's been declining labor productivity growth. So the two factors, declining labor force growth and declining labor productivity, have caused underlying potential growth to be slower. Now, the underlying growth that we see in the economy is expected to remain low in advanced economies or slow further. Therefore, the cyclical forces that normally help to propel an economy out of an expected downturn, namely business and residential investment, as well as large durable goods purchases, may be less powerful in those circumstances, especially if debt levels are high and confidence amongst households and firms is slow to rebound. In such circumstances, policy might have to be more aggressive to boost confidence and increase demand. Now, the policy implications of these developments were the focus of our discussions in September 2017 at a public workshop we hosted at the bank to launch our 2021 research agenda. We invited Canadian and international academics, journalists and economists from the private sector, think tanks and unions to suggest ideas for our research agenda. The ideas that came out of the workshop can be grouped into three broad sets of issues regarding the monetary policy framework. First, its objective. Second, the available tools to achieve the objective. And third, the potential role of policy coordination. Let me say a few words about each. On our objective, one alternative that participants at this workshop discussed was a switch to price level targeting, or PLT, from inflation targeting. Now, under PLT, monetary policy would seek over time to keep the price level rather than the inflation rate on a predetermined path. This would imply that past deviations from this path would have to be reversed, likely gradually with higher or lower rates of inflation. We researched PLT for the 2011 renewal, and in the end, we concluded that its benefits did not clearly outweigh the costs and risks of making the shift. But we also said that our assessment of PLT could change in the future. Now, what about tools? In recent years, central banks have used various tools to ease monetary conditions and to stimulate demand when their policy rate was at the effective lower bound. For example, in 2009, we issued a conditional commitment to keep the key policy rate unchanged for a year as long as our outlook for inflation didn't change. Other central banks have also used explicit forward guidance as well as large-scale asset purchases, typically of government securities, for this purpose of stimulating demand. Further research is needed to examine the effectiveness of these tools and how best to use them. Finally, the experience during the crisis when both aggressive monetary and fiscal stimulus were used highlighted the benefits of simultaneous policy action. Although monetary policy is normally seen as the most effective countercyclical tool because it can respond flexibly and nimbly to adverse shocks, it may need support from other policies more frequently in the future. Indeed, studies have shown that when rates are at the effective lower bound, countercyclical fiscal policies such as employment insurance and similar automatic stabilizers and discretionary policies such as infrastructure spending are highly effective in stimulating demand. Our agreement with the federal government includes a commitment by both the bank and the government to the inflation target. That means all economic policies, including monetary, fiscal, and macroprudential, can work together in a complementary fashion for this purpose. Let me conclude. Canada's experience with inflation targeting has been much more successful than originally expected. In hindsight, we underestimated how powerful inflation expectations would be in keeping inflation close to target. Our policy framework continues to work and work well. Inflation and inflation expectations remain firmly anchored. And the framework's strengths can be summarized in the following 3 points. It features a clear, simple, and well-understood target, a focal point at 2%. The agreement with the government about the framework underpins its credibility. And finally, it is continually improved through the renewal process to ensure that we are able to meet future challenges like the ones I just highlighted. A strong framework enhances the resilience of the economy, making it better able to weather adverse shocks. An important recent example of a shock that affected the regions in the west of Canada especially was a sizable oil and commodity price decline in 2014 and 2015. The policy rate reductions the Bank of Canada made in 2015 in response to the shock were effective in facilitating the economy's adjustment and returning inflation to target. Dans les prochains exposés de cette série, axés sur l'examen de notre cadre, nous allons finaliser et vous présenter les questions de recherche que nous allons étudier en vue du renouvellement de 2021. Nous restons persuadés que les meilleures contributions que la Banque puisse apporter à l'économie du Canada est de maintenir l'inflation à un niveau bas, stable et prévisible. In coming speeches in this series on the review of our framework, we will finalize and share with you the research questions we will be working on leading up to the 2021 renewal. We continue to believe that the best contribution the bank can make to improving the performance of the Canadian economy is to ensure that inflation remains low, stable, and predictable. Thank you very much for your attention. I would be happy to answer any questions or receive any comments you might have. Thank you.
Thank you, Dr. Schembri.
Oh, thanks, John.
For those that have questions, please, we have 2 microphones, one on either side of the room, so that folks on the webcast can hear. Please step up to the microphone and ask your questions from there. Who has questions? There's got to be some in here, I'm sure. Okay. Come on up.
Thanks for your time today. You discussed the low neutral rate. Has the bank done any work on the outlook of neutral, and specifically, what are the most important drivers that could affect the level of neutral going forward over the next few years? Thanks.
Thank you for the question. Well, 10 years ago, we used to think the neutral rate was somewhere in the neighborhood of 4.5% for our policy rate, which is a target for the overnight rate. Over time, that's declined, and our thinking now is that it's in the range of 2.5% to 3.5%. So it's very difficult to estimate the neutral rate, but we now think it's roughly in that range of 2.5 to 3.5. And every year when we reassess our outlook for potential output growth in Canada, we at the same time look at what our estimated range for the neutral rate is. And so we do that in the April monetary policy report. So if you look forward to April, we will see our next outlook. But in general, the trend, as I explained, has been to reduce the neutral rate in a downward direction. And that's been true in other central banks as well. And so I can't predict exactly what will happen, but the tendency in the past has been that the neutral policy rate has been revised downwards.
I have a question.
Sure.
With respect to growing household debt in Canada, people tend to make decisions when they have some certainty around what those things will be. So with keeping the inflation rate steady, which in turn keeps interest rates fairly steady, is steady monetary policy and steady inflation rate helping drive that debt up because people are making decisions in the face of somewhat certainty that long-term interest rates will stay low?
Well, interest rates recently have been low, and that's contributed to the increase in household debt. As you know, in our last policy statement, we said that given the outlook for the Canadian economy, since we're operating close to potential output now, and inflation is close to 2%, that we expect that higher interest rates will be warranted. Now, the approach we're taking with respect to interest rates in the future is really a cautious approach. We understand there are a number of vulnerabilities or uncertainties surrounding the Canadian outlook, in particular the future of NAFTA, the negotiations, different trade policies that have been enacted by our neighbors to the south. Also in terms of the policies that OSFI has brought into place in terms of stress testing, mortgages, requirements in the uninsured space, that's going to have an impact on residential investment. So there are these uncertainties, and so we're taking a cautious approach to the path of interest rates going forward. Now, that doesn't mean that interest rates are going to remain low forever, but at some point they will increase. At the same time, we're being cautious. We're also following the data very closely, and the governor's described this as being data dependent, that we're looking at certain pressures in the economy, inflationary pressures, and deciding on that basis how quickly we should increase interest rates. So there's a balance between the two, being cautious, recognizing that there's important uncertainties facing the Canadian economy, but at the same time recognizing that and monitoring the inflationary pressures and how they develop in the economy.
Thank you. Paul?
Thank you very much for coming today. Paul Beck of Manitoba Bureau of Statistics. My question regarding your definition of inflation. Right now you guys use CPI and 3 variations on it.
Right.
Has there been any debate about broadening that definition to including some forms of asset inflation, broadening it to the greater part of the economy? Thank you.
Well, the issue, that's a very good question. We focus on CPI inflation because that is the best representative of the household consumption basket. So that's really what Canadians actually consume, and so that's why it's our target. We also use three different measures to measure core inflation, which attempts to strip out the factors that cause temporary movements in CPI, because we use the core inflation measures to get a sense of where the economy is at this point in time, because these core inflation measures are related to the output gap, that if we have excess supply in the economy, typically these core inflation measures will be below 2%. If we were to have excess demand, they would be typically above 2%. So they serve as a means of determining where the economy is now. But the target going forward is really the CPI. Now, the question you asked is whether we should broaden the CPI to include asset prices. And that question comes up from time to time. Now, there are measures of housing in the cost of housing in the CPI. One can debate how good those measures of housing are in the CPI, but they're there. Like other asset prices, whether it be stocks or bonds, that's something I think for the most part everyone agrees should not be included. The issue is really where there is some debate is how best to measure the cost of housing. And so to what extent should movements in housing prices influence directly the cost of housing? So that's a live topic for certain.
Chris?
You know, we saw with the financial crisis that a lot of key things that are kind of outside of the inflation targeting framework are quite important to the stability of an economy. You know, and I know the bank and many other banks have been spending a lot of time looking at factors like that. But that seems to be somewhat outside of the scope of the targeting framework. But it seems to be becoming more important. So I just wondered if you could talk a little bit about some of the things that the bank has been looking at.
Very good question. Actually, it is related to the inflation targeting framework. I mean, I think one of the lessons we learned from the global financial crisis is that during the 2000s, there was a high degree of macro stability. Growth was strong in the world, inflation was relatively low, and so everyone took a lot of comfort. Some people called that the great moderation because things were going so well in the 2000s. But the problem was that macro stability is not a sufficient condition for financial stability. At the same time, the economy was growing and inflation was low. We had all kinds of financial vulnerabilities, especially in the United States and other advanced economies, growing in large part because financial regulation and supervision did not stay on top of the innovation that was taking place in the financial sector. And we saw what happened in the United States with respect to subprime mortgages, which was a key component or key element of the financial crisis there. So that's what happened in the United States. What happened in Canada, our experience was much different in the sense that we did have very effective financial regulation supervisions, so none of our banks failed during the financial crisis. And this was different than the experience in other advanced economies. And so that's partly why the inflation target was so effective, is because we had this policy coherence with the framework that we developed in Canada to regulate and supervise financial institutions. So the two things do go together. And we have to be mindful when we conduct monetary policy, the policy is transmitted through the financial system, so that having a stable financial system is necessary for effective monetary policy. So again, the two things do go together.
Thank you. Any further questions for Dr. Schembri? Yep, one more.
You've sort of indicated some of the things that you're looking at when you do the renewal process for 2021. One is household debt, the fact that with the household debt rate high, and also the fact that interest rates have trended declining over time. And the third point, the economic fundamentals are starting to look weaker, especially with the aging population and labor force growth. So I'm kind of thinking, are we sort of looking at a target rate that's going to be lower from the current 2% rate that you have? Because if you have a weaker economy, you tend to look at inflation pressures to be lesser in the economy. So is there a trend to sort of look at a target rate that's going to be lower for the longer term?
Well, the issue with a lower target rate is that that means the neutral policy rate would also be lower. So as I said, for example, with a 2% inflation target, we have a target rate for the neutral policy rate of roughly 2.5 to 3.5%. Now, for example, if we were to lower that target inflation rate from 2 to 1%, that target range would roughly go from 1.5 to 2.5%. So that means we'd have even less room to cut interest rates if there was an adverse shock to the economy. So that's the problem. So that's the downside to reducing the target inflation rate, is that if there was an adverse shock, it's much more difficult for us to respond. And so that's why at this juncture we feel very comfortable with the 2% rate.
The only follow-up I'll have on that is we have an aging population, more and more dependent on fixed income. So higher inflation will impact a broader component of the country now than it will, or in the future than it will now, I suppose.
Well, I agree. I mentioned in my presentation that for the people that are on lower fixed incomes, higher inflation is a cost for them because they typically don't have the wherewithal to hedge their financial position against higher inflation. So from that perspective, higher inflation we see as being socially unjust. So that's a reason for keeping inflation relatively low, the target.
Well, if there are no further questions, then I'd like to take this opportunity to thank you, Dr. Schembri.
Oh, my pleasure. Thanks, John.
It's been a pleasure for me.